Same with crypto. What you're hedging here is not inflation, i.e. prices rising, which is usually demand or supply driven. What you're hedging is the debasement of currency, where your purchasing power goes down. So, okay, let's go back one step. What is Bitcoin? Bitcoin is a scarce digital asset, and we either choose to accept it or not, right? Like everything, like gold it's just a metal, but the meme says we should accept it as something of value. So Bitcoin is a meme that is the digital store of value. But it is also a technology. So if we think of Ethereum now and the rest of the crypto space, this is a new tech of which we can use blockchain for a whole bunch of different things. So what we've got is the scarce asset and technology. Okay, great. That's worth something. The other side of the equation is, as you mentioned before, these however many white dudes, aging white dudes in the United States, set the monetary policy for the world, essentially. That liquidity washes in and out of markets. So when it washes out of markets, as it is right now, they're raising interest rates and they're reducing the balance sheet. That's taking money out of the system. So it's a game of musical chairs. So what happens is people are scrambling for dollars, and both, you see currencies falling around the world, but also people can afford less assets because there's less leverage, less money around. So the price of Bitcoin, NASDAQ, everything falls. I mean, literally everything, house prices. And the dollar goes up because there's less dollars around. Same with what's happening right now. So if we go back to 2020, what happened was massive liquidity coming in, plus debasement of currencies, quantitative easing. Right now, we've got the opposite of debasing of currencies. We've got quantitative tightening. So the currency is actually getting stronger. So the assets should go down versus that. But back then, we had like a 50% increase in the Fed balance sheet. We've never seen that much monetary expansion in the modern history of the United States. And so what happens is you then look at all of the assets, and what did best out of that was Bitcoin, or all of crypto. Why? Because not only, so gold did okay and equities did well, but Bitcoin did really well because you had both the technology bet and the monetary bet. And so it outperformed. So if we're in an age when the central banks are straddled, the global economies are straddled with debt, and this doesn't apply to India as much as it applies to the Western developed nations, is their only answer is to print money to avoid catastrophe, because who pays the debt? So the central banks backstop it. So over time, they're going to keep doing this trick because it's a magic trick, because it makes asset prices go up and everyone looks like they're rich, but you're not rich, because you actually can't afford a house because it keeps going up in value because your wages don't go up. And the asset you need to own for all of that is crypto, because it's the thing that outperforms and gives you more purchasing power. That's happening right now. Yes, but it's not inflation as in the rising cost of gasoline prices. It's to do with fixed asset inflation, houses, stock market, Rolex watches, and art, all of that stuff that's supposed to hold value, that goes up a lot when you debase the currency. All of these things with variable amounts, like your wages, don't go up, which is why the rich get richer because they own all the stuff, and the poor get poorer because they just get income, and income never goes up as much. Yeah, okay. The US is 25% of world GDP. It is 87%. The US dollar is 87% of every trade transaction in the world. And it's also the most indebted nation in the history of the world. It's 100% of world GDP in debt. But not only that, everybody else is in debt in dollars. So when things get scary, you go to the safest asset, which is the dollar. But there's always a scarcity of dollars because the US is only 25%. So it can't ever generate enough dollars for the system until it massively prints dollars and then gives them out to people. So the dollar is always in short supply globally. And in recessions, it's in extreme short supply. So right now, because the Fed are taking dollars out of the system, the dollar is going up a lot. So over time, this dollar shortage just keeps playing out. Everybody uses the dollars because they have to, because 87% of trade is in dollars. So you've kind of got a gun to your head. You need to use dollars. So when India buys oil from Mexico, let's say, whoever you buy it from, or from Saudi, you pay dollars. That's neither of your base currencies, but you have to go and buy dollars in the open market to do that. Well, it's not your currency. It's not the Saudis' currency. Yeah, sure, Saudis pegged to the dollar because they have to be, because oil's priced in dollars. So this is the issue, is everything is in the dollar and nobody has it. And the US is in control of it, which is why those bunch of baby boomers based in Washington control the world. Okay, so there's two schools of thought. The current strongest narrative, which is not the view I share, is that in a world that is deglobalizing, like we're taking Russia out of the world, we're trying to remove China out of the world, there's not enough, and also a world that's moving towards, moving away from fossil fuels. We don't have enough investment in mining fossil fuels, that kind of stuff. And therefore any demand in the upcycle means that prices rise and we get inflation. Also, the fact that people like the US have to, or the Europeans have to build factories in their own countries, i.e. onshoring, means that wages rise in those countries. And therefore, people are suggesting that prices are going to be stickier for longer. So they're saying the big narrative is, well, inflation's probably going to be about 4%, and therefore interest rates about 4% for another 5, 6, whatever years. And we've gone to a new regime. My argument is the regime looks confusing because we had the pandemic, we shut down the world, we reopened the world, there wasn't enough supply, so prices rose massively. And we're seeing the recession that has caused. Interest rates went up, prices went up, everyone's like, oh my God, I've got no money. And the downside of that, I believe, is deflation. And I think deflation is a structurally larger force. Why? Because in the Western world, the population is aging. It's completely the opposite of India. So India average age is 28, the United States is 58, and Europe is older. So we have a record number of retirees. Now, if you've ever seen your parents retire, one thing they end up doing is not spend as much money. Why is that? It's just human psychology. You don't know how long you're going to live for, and you've got a fixed amount of money left. So the first thing you say is, oh shit, I need to stop spending because I don't want to be 85 and homeless. Right? So it's a really strong thing. So there's two schools of thought. Spending collapses, and so the economy tends to be deflationary. But then there's another mega power, which is globalization. Even though we're in globalization retreat, don't forget, places like India become the net beneficiary here. If China's not the great counterparty, then India is more neutral in the middle and is a more trusted counterparty with the rule of law, etc. So globalization continues, but maybe more regional. Okay. But then there's the really big super trend, and that's technology. Basically, everything that gets digitized goes to zero in value. I mean, everything. So cloud computing, computing power, computing chips. I mean, you name it, televisions, mobile phones, everything goes to zero. So it's an incredibly deflationary force. And that's only about to accelerate because we've now got green energy, which is getting cheaper and cheaper and cheaper and cheaper, and that's going to accelerate. We've got artificial intelligence, which is replacing humans, robotics replacing humans, biotech sciences, we've got Internet of Things, we've got so many, we've got space, we've got so many massive technologies all going exponential in their adoption all at the same time. That's a very, very, very deflationary force. So I think deflation is the more likely outcome. And to give you a historical comparison, we've only really shut down the world a few times in the past. The last one was obviously World War II. So World War II, the whole world was shut. Everybody was out of the labor force and in the state sector or in military or working on bombs and planes and that stuff. So what happens after World War II? 1946, everybody comes into the labor force looking for a job. Everybody wants to spend some money because they've been out in the military. Nobody's in the factories yet. So we get this massive supply demand issue, which is very similar to post-pandemic. And what happens is CPI in the United States goes up to 20%. The Federal Reserve raised interest. Well, it wasn't the Federal Reserve raised rates. And then what happens is we went straight to deflation 18 months later. Then we have a rebound, and then we settle in this period of interest rates were about 3%. Inflation was about 3%, and interest rates were about 2%. And we did that for 20 years, a massive fiscal stimulus.